Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Remember, if you'd like to know the absolute latest on any commercial real estate related subjects, check out our show podcasts. We recently produced shows on the REIT market, senior housing, a show on tax credits, an interesting show on commercial real estate technology, and a show on CMBS loan resolutions. There's lots of interesting shows to choose from. Just click the tab Shows on Demand at commercialrealestateshow.com. Today we're exploring the U.S. office market. Please welcome my next guest, Mitch Roschelle, partner, U.S. real estate advisory practice leader with PricewaterhouseCoopers. PwC is a global professional services network with 169,000 professionals worldwide. Mitch Roschelle, thanks for joining us today.
Good morning, Michael. Thanks for having me.
Well, thank you. And we'd like to get a little perspective on the office market from you, Mitch. What did you see in the second quarter numbers around the U.S. for the office market?
Sure. And maybe we step back a little bit, not to totally avoid your question, but and look at sort of where we've come from. And if we look at, and I think this will lay a foundation, no pun intended, for the comments that I'll make after. So if we go back to 2008, we saw just under 79 million square feet of new additions to the office stock across America. That fell to 50 million the next year, fell to 21 million in 10, fell to 9 million in 11, and for the first quarter of 12, it's 1.4 million. So a lot of that is pipeline, because if you started projects in 05 before the bubble burst, you would have delivered them. But we've clearly pulled back in terms of our additions to new stock. To throw a few other numbers at it, if we look at net absorption, 2008 still saw a positive net absorption with 13 million square feet being absorbed. 9 was a bit of a train wreck with negative 42 million square feet of net absorption. In 10 and 11, we sort of slugged around both years at about 20 million. And interestingly enough, in the first quarter of 12, there was negative net absorption, but I think you can't look at those data points on a one-quarter standalone basis. So big picture takeaway, we haven't added to new stock. We're positively absorbing what we have in the pipeline, which I think lays a foundation for improvements to rents in the future as demand creeps back into the market.
Well, let's talk about rental rates. Did you see some improvements in the second quarter?
Yeah, and we have an interesting chart on that, which your viewers online may be able to see. So if you look at what's happened over time, and maybe this isn't a big news flash, but as market rental rate expectations begin to go up, and where does this information come from? PwC has been publishing for 25 years something we call the PwC Real Estate Investor Survey. We survey market participants every quarter and get their insights on what they think is going to happen in the future. So unlike some other data sources that are out there which look backwards, ours actually looks forward, and you can see a nice positive trend, which is in the red line there, where market rent expectations are going up, and at the same time, as a result, cap rates are coming down, which is a sign of increased investor sentiment. Why is that happening? I think it goes back to my comments on the previous question. Demand is creeping back into the market, and we have less space being added. We're not flooding markets with excess space, so supply and demand's kicking in, and that's forcing rents to go up.
Yeah, that's interesting. And I think that's another reason that commercial real estate investments can be a relatively safe investment when you look at all the other choices. Because of lack of construction, it kind of takes care of itself in some ways. And speaking of that, what do you see for cap rates and sales volume and investment sales related to the office sector?
Yeah, so in an interesting way of looking at it, and maybe we look at things differently than others, and it's another very colorful chart that we have. But we've looked at the last 12 months on a rolling basis, and we've looked at the markets across the country and what percentage of the stock, the inventory of office space in those markets have changed hands, and that tells you a little bit about where investors are looking and where do investors expect positive rent growth and positive absorption, right? So the overall average is across all the markets we looked at is 9%, meaning 9% in square footage of all the space in that market has traded hands. Some markets really stand out, like Denver, Houston, Dallas as being considerably above the 9% average. In fact, Denver is at 18%, which is twice the national average. Then if you look at some slightly smaller markets, northern New Jersey, Phoenix, San Diego stand out as markets where investors are looking and buying. And then lastly, in the even smaller markets, San Jose, Long Island, Austin, Texas, Miami. So take some of those markets, and if you step back and think about some of the headlines that we saw in the wake of the financial crisis that we experienced in this country, some of those were markets that you would have thought were left for dead. They were associated with the overbuilding of residential housing. And if you looked at suburban markets, you looked at office buildings, there was a high percentage of occupancy in office buildings that were tied to the residential housing world. So you had office suites that had mortgage brokers in them, lawyers, title companies, residential brokers. So there's a lot of space occupying office product tied to the residential market, tied to the construction of homes. A lot of those businesses scaled down because the volume was down. So when the volume in residential mortgages comes back, when the volume in home sales starts to come back, some of that use creeps back into the market. But as jobs are just getting created in those markets in general, that space is filling up, driving rents, and more importantly, driving investor sentiment in those markets, and we're seeing trades of office product in those markets.
Right. Follow the jobs. Well, let's jump to the job market a little bit more. I mean, the office sector is obviously affected by the job market, as you say. What are the real numbers and some of the current trends for unemployment and job growth?
So we looked at it in two different markets, which we found interesting, and what we did was we compared unemployment statistics to cap rates, just to see if there was an interesting correlation. So I want to start with South Florida, because picking up on the theme that I mentioned earlier of some markets that may have been somewhat left for dead by investors. So you see unemployment peaking, about 18 months ago, almost 10%, and unemployment falling over time to, maybe 200 basis points from that sort of high watermark. And coincidentally, you see cap rates falling in line. So cap rates is a measurement of investor sentiment in the office sector in South Florida, going hand in hand with unemployment falling in South Florida. So like you said earlier, Michael, follow the jobs. Where we're seeing job growth, we're seeing investor sentiment improving. And make no mistake about it, some of the markets that I mentioned earlier where investors are interested, like Denver, Colorado, like Houston, like Dallas, northern New Jersey, San Jose, Long Island, these are places too where there is positive improvements in the job market, and that's why there's an interest in investing ahead of the curve.
Well, Mitch, I want to get your opinion on the election results and what that might do to the office market. We have to take a quick break. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back. Commercial real estate videos are brought to you by Bull Realty. When your business requires proven performance, contact Bull Realty. And by Arnold Golden Gregory, France Media Inc., Resnick Group, and Andy's Army. Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. Would you like to attract visitors to your website with the Commercial Real Estate Show? Well, now you can download a free widget allowing your site visitors to access show videos and audio podcasts. Just visit commercialrealestateshow.com and look for the widget on the homepage. Well, today, we're exploring the U.S. office market. I have on the phone with me Mitch Roschelle with PwC. And Mitch, I'd like to get your opinion on the election results and job growth. And do you think the results either way could have some effect on job growth and the office market?
It's tough to say. However, I'll say one thing first, and then I'll give you the prediction, which is, I think in the first instance, we have to remember how sensitive the real estate asset class is to jobs. And I don't think that one candidate versus the other is going to have more of an impact than the other. I think the bigger thing is the rhetoric in the debates going into the election, I think, could have an impact on the real estate asset class. If investors hear campaign rhetoric that suggests that the interest rate environment may change, regulation may change, lending practices may change, that could cause concern on the part of real estate investors. I don't think one candidate or the other is going to be that accretive or dilutive to the employment market, but I do think what we've seen in past elections is that the campaign rhetoric has caused more concerns on the asset class. We have in the past gone back and done an analysis of, Republicans, Democrats, red states, blue states, and whether or not there's any meaningful impact on real estate values from one party or the other. Interestingly enough, the answer is no. The real estate asset class is a long-lived investment, subject to contractual income. And it's time tested, and one party or another hasn't really had an impact on the sustainability of cash flows and the performance of the asset class. Investor sentiment does shift, though, however, when there are concerns about the future, and if the campaign starts raising concerns about the future, shining a bright light on a specific issue, that could chill markets for a finite period of time, I'd say.
Yeah. Well, it'd be interesting to see what happens with the election results. And, I think some of these companies need to know what's going on and what should they expect with the taxes and things. And, so many companies are sitting on cash. Mitch, why are they not expanding and hiring more? And what are some of the signals that could create more corporate confidence? Yeah,
I'd say two things on that. First, corporate balance sheets are at an all-time high. So as it relates to the office market, I think that's a great thing, because that means that credit is better, and we have credit's important to the vitality of having a tenant. So we have tenants that have more cash, so they have better credit. The other thing to remember about that is companies, the recession is not too far in the rearview mirror, and I think companies are very reluctant to start chasing their overhead and adding to headcount just because they feel like they have the cash. They'd rather hold on to that cash for another purpose, which is M&A activity. And I think one of the things we expect to see in sort of corporate America, if not global corporate behavior, is increased M&A activity. And I think M&A activity is generally good for the real estate asset class, because in the wake of M&A, there's often changes in how offices get used, and I think for those folks who are within your listener community who earn a living based upon transactions, that means more transaction volume. M&A activity doesn't necessarily mean downsizing, using less space. Quite the contrary. I think in the wake of M&A, it's done to grow corporate profits, and as corporate profits grow, they'll use more space. So I think the one big thing to remember about cash on a balance sheet is A, good credit, and B, look for a lot more corporate mergers, acquisitions, and consolidations in the future. Okay. Well, we're short on the break, Mitch, but what are your expectations moving forward? What's your crystal ball say about the office market moving forward? Incredibly bullish on it, and I think to just sort of slightly reiterate something I said in an earlier comment, investors have gotten away from just looking at the core markets. They're looking at markets coast to coast. Core markets, as I said, is a bit of a crowded trade, and the fact that investors are looking in places like Phoenix, like Denver, like South Florida, I think is really good. New capital flowing into those markets is good. That means lenders are going to start lending in markets because equity is coming into the market. It's a real estate and the office market in particular, capital-intensive asset class. We don't only need equity to buy properties, but we need lenders who are willing to finance them, and we're seeing lenders coming back into the market. So my prospects, we see rent growth, we see positive absorption, we see increase in demand with recent historical falling supply. I'm very bullish on the office sector and continue to be.
That sounds good. Well, Mitch, great information as usual. Thanks for joining us today.
Pleasure to be here, and look forward to continuing the dialogue.
If you'd like more from Mitch and PwC, visit pwc.com. Well, we have two of the leading office owners in the country up next. Stay with us. I'm Michael Bull, and this is America's Commercial Real Estate Show. We'll be right back.